After Friday's jobs report blew past expectations while the unemployment rate ticked up, another round of economic data is on deck for investors to digest. And that includes the Fed's interest rate decision and remarks around the path of monetary policy on Wednesday. Here with more on how to best position your portfolio ahead of this big week, we have Ohsung Kwon, Bank of America Director and US and Canada Equities Strategist. Thank you for joining me this morning. I saw that in your latest note, you say a no landing scenario is back on the table. What does this mean for your portfolio if you're trying to really sort of gauge where the Fed is headed from here?
Yeah, so thanks for having me today. And obviously, after the blowout jobs report that we saw on Friday, the no landing debate, we believe that is back on the table. And we don't think that's necessarily bearish for equities. I mean, so far this year, up until I want to say a month ago, that's been the macro environment for equities that, the risk of reacceleration was pretty high. The macro data continued to surprise to the upside, yet equities continue to chug along. Rates were rising, but equities can withstand higher rates as long as growth is staying strong. As long as growth is staying strong, I think higher inflation and higher rates can be withstand by equities.
And of course, we are going to get CPI, PPI data and consumer sentiment also throughout this week as well. What does this mean if you're an investor and you're watching this data, perhaps, given what we saw against that backdrop of the strong jobs market there, how should you be positioning yourself? What should you be focusing on when you head into this week?
I think the risk to equities is still skewed to the upside. The reason why I say that is because the worst case scenario of a weak jobs report plus hotter CPI, that has been avoided after the NFP print last week. If CPI were to soften on Wednesday, that's basically the best case scenario for equities. It's basically risk on. Growth is strong, but inflation is coming down. That's basically the immaculate disinflation that we saw last year. And we all know what happened to equities last year. So I think, investors might want to position for that potential upside in equities. And I think that's really the pain trade. I think the pain trade is still to the upside, especially in cyclicals. And if inflation comes down from here, despite strong growth in the economy, that really positions well for a cyclical upside in equities.
And for people who perhaps might be tempted to have a knee-jerk reaction if they do see another report that's really off what predictions are showing there, what sort of time horizon should people be looking at to really get a real sense of the inflation picture, something that we know is something that the Fed does? They don't just go by one set of data. What sort of time horizon should people be looking at?
Yeah, I mean, it really feels like the market's focused on CPI print on a month-to-month basis. But you got to look at the bigger picture. You got to zoom out and look at the trend of inflation. And so far, it's been coming down. We sort of stalled after that big disinflation that we saw last year, but we're not accelerating right now. And as long as inflation doesn't re-accelerate and growth is still strong, I think equities can work to the upside. And if macro data were to slow going forward, that's essentially what we saw over the past couple of weeks, that macro data started to surprise to the downside. If that's the case, and I'm not talking about growth falling off the cliff, it's just simply normalizing to trend growth levels. That should also result in inflation coming down at least a little bit. I mean, inflation at the end of the day is supply versus demand. Supply side is still, it has gotten a lot better. It's more about demand going forward. And if demand were to moderate, basically to the trend growth level, normalizing to the trend growth level, then that should result in inflation coming down as well. And that's essentially the bull case scenario of soft landing that everyone wanted to see heading into this year, as well as the Fed. So I think there are many ways that equities can win.
So let's talk sectors that you like the look of in this environment. Where's a good place to position yourself?
I think financials looks very interesting. I mean, it's very beaten down, and positioning, everyone hates financials after what happened last year. But these banks are very well capitalized. Fundamentals are very strong, and if growth is strong and corporate profits are accelerating to the upside, I think the macro environment is still pretty favorable for financials. And if the Fed is done hiking, then that should alleviate some of the deposit pressure that financials has seen so far. But the back end of the curve is likely going to remain elevated going forward. I think that's the secular force in the market. And if that's the case, that's essentially pricing power for financials. So I think I like financials. I like energy as well. I like commodities overall.
And for people who are wondering if they've missed the boat on the tech rally, is it too late at this point when you look at where prices are?
I hate to say, but I think so. I mean, tech has rallied so much. Positioning is very crowded. Valuations are pretty expensive. And that's been sort of the consensus trade over the past year and a half or so. And if you think about what really drove tech performance over the past, 2+ years, I think it's really about earnings. I don't think it's necessarily about the macro environment, because heading into 2022, everyone was worried about the hiking cycle and how higher rates are going to play on long duration equities. And essentially that's what we saw in 2022, that tech underperformed massively versus the S&P 500. But if that were to be the case, if rates were really the big driver, then tech should have underperformed last year as well as this year. Obviously, that wasn't the case. I think it was really about earnings. Tech earnings underperformed the entire year in 2022, and it bottomed in around March of last year. And essentially outperformed in terms of earnings since then. And that's essentially what happened for the stock performance as well. Going forward, what's interesting is that tech earnings growth is likely to decelerate, especially the Max 7, whereas non-tech stocks are expected to see accelerating earnings growth going forward. So we think that you could get cheaper growth in non-tech sectors, more cyclicals, more commodities and value-oriented sectors of the market.
So certainly time to shift that focus from the shiny objects that they have in tech. Appreciate you taking the time to join us this morning. Ohsung Kwon, Bank of America Director and US and Canada Equity Strategist. Thank you so much.
Thank you.